you, Mary Lou, and thank all of you for attending this afternoon. My name is Bob Grossman, and I am one of the founding partners of Grossman, Yannick & Ford, where over 3 decades ago we decided to strike out on our own and put together the kind of service firm that we thought the market could use, and we've had a great deal of success, as all of you attending today realize. What we want you to know, though, is that we understand fully that a lot of that success is predicated upon support by people like you who have been with us for many of the years that the firm's been in existence, and that our success is predicated wholly on the confidence that we've been able to build in the community and the support by folks like you. So we hope that these programs, which represent the more than 2 decades of presenting an annual continuing professional education day, will bring some information to you that will help you in your day-to-day practices and businesses and enable you to better understand some of the more difficult and complex issues that all of us face on a day-to-day day-to-day basis in our businesses. Today's presenters represent the first of 4 sessions that will go over 4 Thursdays, as you well know. We do miss seeing all of you in person at South Point, and it is our hope that we'll be able to do that again live next year. But in the name of safety, we felt this was a better avenue to take again for the 2021 sessions. Today's session is the audit and accounting update. We do this annually. There's a lot of complex changes that obviously thread through the accounting pronouncements that come out each year. Very often difficult to interpret without a deep expertise in those areas. So today we bring you 2 of our best, Mark Wolstoncroft, a partner in our audit services group, and Andy Giallonardo, a manager in that group, who will go through some of the more important changes that we've observed over the 12 months and what we can expect in the future. I don't want to take up their time, so I'll turn it over to those guys. Have a good session, everyone.
Thanks, Bob. Appreciate the intro. And I echo Bob's comments in welcoming you to our annual audit and assurance update. As Bob mentioned, I'm Mark Wolstoncroft, and with me today is ANA Update veteran Andy Giallonardo. Many of you that participated last year will recognize Andy from last year's ANA Update program. We've got a full program for you today. We've included our contact information here on this slide in case you have any questions and want to be in touch with us after the program. As Mary Lou mentioned, there is a Q&A feature within today's program. If Andy and I don't address your questions during the presentation, we'll be sure to circle back with you after the presentation. In terms of our objectives for today, our objectives are really to highlight changes to US GAAP and AICPA standards that are recently applicable or that will soon be applicable. We've also carved out 2 recent changes that we want to spend a little bit more time covering. Today, we'll cover 16 ASUs, including 6 that have been issued since last year's program. We'll touch briefly on potential upcoming changes to US GAAP. We'll cover 4 new AICPA statements on auditing standards, 1 new AICPA standard for accounting and review services, and we'll also cover briefly the 2018 Yellow Book update, which became effective on June 30th of 2020. Finally, we'll circle back on 2 matters that we've covered in the past, but are worth revisiting, particularly as we approach year end here. We'll focus some attention on changes to audit reports and engagement letters resulting from SAS 134. Those are changes that you'll see this year when your audit reports are issued. We'll also spend the last roughly 20 minutes on the lease accounting literature that becomes effective for many of us on January 1st, 2022. We've talked about lease standards, it feels like, for years, but it looks like the delays are probably over, and it looks like most of us will be implementing that in 2022. As usual with this ANA update, we're not going to seek to discuss IFRS. We're not going to address SEC and PCAOB matters, and we're not going to spend a lot of time on specialized industries either. As I mentioned, we're going to touch on 16 ASUs today. I'll cover the first 8, and Andy will cover the remaining 8. We're going to walk through these ASUs in chronological order based on when they were originally issued. And in order to leave enough, we want to make sure we leave enough time to cover the changes to the audit reports and the new lease guidance. So we're going to move pretty quickly through the ASUs, really trying to hit the high points. In fact, our program is so packed today, I'm even going to leave out all the bad jokes I usually use in other CPE days, so you don't have to worry about those today. So first, we're going to start with ASU 2016-2 regarding leases. This was initially released in way back in February of 2016, and at that time, the effective dates were planned to be for private companies years after December 15th, 2019. That's been delayed a couple times and is now scheduled to be effective for private companies for fiscal years beginning after December 15th, 2021. So for many of us, that'll be effective for January 1st, 2022. That's one of the topics that we're going to dedicate some time to at the end of the presentation, so I won't spend any more time on that one at this point in time. The second ASU that we have to talk about today is 2017-4 regarding goodwill. Topic 350, which addresses goodwill, has historically provided for a 2-step impairment test. Essentially, first, you compare the fair value of the reporting unit to the carrying value, inclusive of the goodwill. And then if the fair value was lower than the carrying value, then companies calculated a goodwill impairment charge by comparing the implied fair value of the goodwill to its carrying amount. The primary goal of this ASU was to simplify the goodwill impairment test in an effort to provide cost savings for entities. This was accomplished by removing the requirement to determine the fair value of the individual assets and liabilities, which was required in order to calculate the reporting unit's implied goodwill under the current GAAP. After the adoption of this ASU, we get rid of the second step. We simply compare the fair value of the reporting unit to the carrying value, and if the fair value exceeds the carrying amount, no impairment should be recorded. Vice versa, you should recognize a loss, but that loss should never be more than the goodwill allocated to the reporting unit. And then, of course, any impairment loss on goodwill can't be reversed after it's recognized. So even if things improve in the coming year, you don't get to reverse the impairment loss you might have reflected in the previous year. Next up, we have an ASU regarding derivatives and hedging. The purpose of this ASU was really to make targeted improvements to the accounting for hedging activities. Because these provisions were largely targeted improvements and simplifications, many entities to which this ASU applies have likely already considered these provisions. But generally, as an overview, the ASU more closely aligned the results of the hedge accounting with the underlying risk management activities. It also helped to align the timing of the recognition of the hedge results with the earnings effect on the hedged item. So the hedge and the hedged item both get recorded in the same period. Likewise, it synced up the classification of both the effect of the hedging instrument and the hedged item in the same line item in the income statement. This ASU provides for tabular disclosures, especially relative to the financial effects and the amount of the underlying hedges, which I like the tabular presentation. I think that's helpful and makes it easy to digest. And then finally, an important provision of this ASU was that previously you had to prepare hedge documentation with respect to the effectiveness before the hedge started, and this ASU allows you to look at it after the and document the hedge after the hedge has started. So provides a little bit of help, especially for privately held companies. Moving on to 2018-14, this ASU deals with defined benefit retirement plan disclosures. It removes a variety of disclosure requirements, including it removes the need to reconcile opening and closing balances of plan assets measured on a recurring basis in level 3 of the fair value hierarchy. So a lot of the fair value guidance that was originally rolled out, some of that is being scaled back, and this is an example of some of that scale back. The ASU also adds disclosure requirements for weighted average interest crediting rates for cash balance plans and other plans with promised interest crediting rates. Also, it added a disclosure requirement for an explanation of the reasons for significant gains and losses related to changes in the benefit obligation for the reporting period. The ASU also clarifies certain information for defined benefit pension plans should be disclosed, in particular, the projected benefit obligation and fair value of plan assets for plans that have projected benefit obligations in excess of plan assets, and similarly, the accumulated benefit obligation and fair value of plan assets for plans with accumulated benefit obligations in excess of plan assets. I think a lot of folks were doing that previously, but this clarifies that that is necessary. 2018-15 deals with internal use software. Prior to this ASU, GAAP did not specifically address the accounting for implementation costs of a hosting arrangement that is a service contract. This ASU, essentially aligns the requirements for capitalizing implementation costs of those arrangements with the arrangements or with capitalizing implementation costs incurred to develop or obtain internal use software. So aligning these hosting arrangements that are service contracts with the internal use software guidance. Accordingly, things like training costs and certain data conversion costs can't be capitalized, and the stage of the project is important. Costs for implementation activities in the application development stage are capitalized, of course, depending on the nature of those costs, while costs incurred during the preliminary project and post-implementation stages are expensed as the activities are performed. 2018-17 deals with consolidation of variable interest entities. There's new decision-making fees guidance, and that's expected to reduce the risk that decision makers with insignificant direct and indirect interests could be deemed the primary beneficiary of a VIE. That's principally for the public entities, and then I'd say thanks to the work of the Private Company Council, there was previously a private company alternative to not apply the VIE guidance to lease arrangements under common control, and this ASU further expands the alternative to include all private company common control arrangements, as long as the common control parent and the legal entity being evaluated for consolidation are not public business entities. So generally, I like the Private Company Council provisions. I liked the fact that they scaled back the VIE guidance for the common control entities, and this further expands that. ASU 2018-18 deals with collaborative arrangements. Topic 808, regarding collaborative arrangements, has not historically provided comprehensive recognition or measurement guidance for those arrangements. And as a result, the accounting for those arrangements is often based on either an analogy to other accounting literature or an accounting policy election. And, because of that, there's been diversity in practice in accounting for these collaborative arrangements. The amendments in this update, they make targeted improvements, particularly around aligning the collaborative arrangements literature with the revenue recognition guidance in topic 606. And finally, before I turn things over to Andy, we have ASU 2019-2 regarding income taxes. This was part of FASB's simplification initiative. It removes 4 exceptions related to things like intra-period tax allocations, foreign subsidiaries, and interim periods. It also requires recognition of a franchise tax that is partially based on income as an income-based tax as opposed to another tax. And then there are some other provisions in that ASU that are listed on this slide. I'm not going to go through those in detail at this point. That brings us to our first polling question. We'll have 4 polling questions today. This first polling question has to deal with reference rate reform. Andy's going to have a slide shortly regarding an ASU that deals with reference rate reform. And the question here is, do you expect that your organization will be impacted by changes brought on by reference rate reform? Yes, this is a significant issue for us. Yes, but the impact is expected to be limited, or no, we really don't expect an impact. And we have some results that you can see on the screen there. And generally, it seems like folks do not expect an impact. Surely folks with debt arrangements that were based on LIBOR will see a change to something other than LIBOR, but other than that, it doesn't surprise me that the impact for many of you will be limited there. All right, Andy, over to you.
All right. Thanks, Mark. It's great to be back this year. I'd love to help facilitate everyone with their ANA CPE needs. So with that, I'm going to jump into ASU 2020-05 related to topic 606 revenue recognition. This is an easy one. Basically, this was issued last year in June 2020 as a little bit of transition relief for those entities that had not yet adopted the literature. Basically gave them another year, and it's effective for reporting periods beginning after December 15th, 2020. Moving on, ASU 2020-06 relates to topics 470 and 815, debt and derivatives and hedging. This is a pretty meaty ASU, so I'm just going to hit the highlights here in the interest of time. But essentially, one of the main provisions of this ASU is that it reduces the number of accounting models for convertible debt instruments and preferred stock. In current guidance, there are 5 models for these items, and this update effectively reduces those 5 models down to 1 that allows convertible debt instruments to be recorded as a liability and preferred stock to be recorded as a single equity item. There are certain exceptions, and if these apply to you, we recommend digging a little bit more into this literature for those items. Also, this ASU updates and introduces a scope exception for contracts in an entity's own equity. In current guidance, There are a number of conditions that are required to meet this scope exception. This update revises that guidance and clarifies the scope of measurement, the classification as assets, liabilities, or equity of these items, and disclosure of these instruments in order to simplify the exception, or the assessment for this scope exception, rather. And then the last major update included in this ASU is that it aligns the calculations of earnings per share with these accounting models and scope exceptions that I've discussed. This is effective for periods for public companies after December 31st, 21, and for private companies, December 31st, 2023. Next is ASU 2020-07, topic 958, not-for-profit entities. Basically, this update requires separate presentation of contributed non-financial assets in the statement of activities, and these would be apart from contributions of cash and other financial assets. So non-financial assets are essentially property, equipment, services, in-kind, and what this update requires is that these are disaggregated on the statement of activities by type, and then additional disclosures be required for additional qualitative information about whether these assets were monetized or utilized. And then there's other required disclosures relative to restrictions and valuation. The next is ASU 2021-01, reference rate reform, which Mark mentioned earlier. As many of you know, the derivatives market is undergoing various transitions due to reference rate reform initiatives, including the widely publicized replacement of the LIBOR rate. The amendments in this update are elective for entities and apply to all entities that have derivative instruments that use an interest rate for things like margining, discounting, or contract price alignment that's modified as a result of this reference rate reform. These amendments also apply to certain interest rate swaps that can be classified as hedging instruments under the new guidance. It's important to note that these amendments do not apply to new or existing hedging relationships or contract modifications after December 31st, 2022. ASU 2021-02 also relates to topic 606, this time specific to franchisors. This update provides a practical expedient that permits franchisors to account for pre-opening service costs provided to a franchisee as a distinct performance obligation. So there's a policy election that can be made by franchisors that can take certain costs, and those costs include assistance in the selection of a site for the franchise, assistance in obtaining facilities and preparing those for use, financing costs, lease negotiation costs. There is a full special or specific list that is provided in the guidance, and if this applies to you, we recommend taking a look at that list. ASU 2021-03, topic 350 relating to goodwill. Specifically, this relates to triggering events under an accounting alternative. So this provides private companies and not-for-profit organizations with an alternative that goodwill impairment be considered at the end of a reporting period rather than on the triggering event date. In previous guidance, it was the triggering event date that was utilized to measure potential impairment. This gives a little bit of leeway to the end of the reporting period in order to measure impairment moving forward. ASU 2021-04 is another pretty meaty topic. It hits a number of areas, topics 260, 470, 718, and 815. I'm not going to get into all the provisions here, but want to hit kind of the main provision in this update. And that is that the update clarifies whether an issuer should account for a modification or an exchange of a freestanding equity classified written call option that remains equity classified after modification or exchange as either an adjustment to equity and the related effects on earnings per share, or as an expense and update or provides new disclosure for the manner of recognition of that event or expense. So that is effective for all entities beginning after December 15th, 2021. And the last update I'll talk about quickly here is ASU 2021-05. That relates to leases, topic 842, which we'll talk about more later on. This was specifically related to lesser accounting for certain leases with variable lease payments. As the topic was originally written, a lessor was to exclude certain lease payments expected from a lessee in the recognition of an initial lease receivable, and would have recognized the day one loss despite believing that the overall lease would be profitable. So what this update does is it takes care of that day one loss issue by treating these leases more like operating leases, such that the lessor would not recognize that loss. So with that, I'm going to turn it back over to Mark for some potential changes to US GAAP that are upcoming.
Thanks, Andy. We'll go through potential changes pretty quickly. There's only currently one exposure draft that's open for comment. Has to do with fair value measurement for equity securities that are subject to contractual sales restrictions. Pretty specific item. Not going to go over that in detail right now. It is worth noting that the FASB's current technical agenda, it includes nearly 30 projects right now, broad range of topics. And if anybody's interested, there's a full list of those projects available at FASB.org. A couple things that, are interesting as I look through there. FASB's looking again at allowing amortization of goodwill and perhaps removing the impairment model that we talked about a little bit earlier. Of course, privately held companies do have an option to amortize goodwill, but they're looking at that, more globally too. And then it looks like they're also looking again at accounting for contingent consideration in a business combination, which, is something that just changed 5 to 7 years ago. And they're looking at whether or not those changes were effective. So always some things going on. At the FASB, always projects open, and we'll continue to keep an eye on those, and I'm sure we'll be talking about some of those again in the future. That brings us to our next polling question, and I saw some of the Q&A that folks had some trouble responding to the last polling question, so please feel free to answer quickly, and I'll make sure to take a little bit more time on this slide. Apologize if I was too fast last time using this new system. But this second polling question has to do with the Private Company Council. That's the primary advisory board to the FASB on private company matters. Since being established in 2012, the PCC has worked with the FASB to establish some alternatives for private companies. Some of those include alternatives to simplify accounting for goodwill, business acquisitions, consolidation of VIEs, and various other simplification efforts for privately held companies. So the question here is, how would you assess the impact of the Private Company Council and their simplification initiatives for private companies over the years? Favorable, they've done a good job. Favorable, but I'd like to see them do more. Neutral, or unfavorable. I'll wait just a few more seconds for you to finish answering that question, and then we'll take a quick look at the results. All right. So we got a lot of folks that are neutral on the Private Company Council, but also nearly 30% that are favorable. And as an auditor that is responsible for a lot of the disclosures for folks, I like the simplification efforts, and do hope to see them do more into the future.
All right, out of that polling question, we're going to start talking a little bit about updates to statements on auditing standards. If you were a part of this last year, you'll remember that I hit a number of these topics as there were a number of SASs that were issued and supposed to be effective in the prior year, SAS 134 through 140, that brought on a number of changes in auditor communications and reporting requirements. Those were then extended effective after periods December 15th, 2021 via SAS 141. So I'm not going to talk a whole lot about these, but I have included main provisions of each in the slide. So I'm going to skip ahead a couple of slides here because there have been 4 more statements on auditing standards that have been issued since we discussed these last year. So starting with SAS 142, this was initially issued July 2020, but it's effective after periods ending 2022. This is related to audit evidence, and it expands our guidance as auditors on obtaining sufficient and appropriate audit evidence. So we have specific rules which what we can look at that applies as audit evidence, and so this SAS was issued to kind of expand and enhance those rules. Interestingly, it also provides guidance on the use of automated tools and techniques that are used by auditors. These are going to be more popular moving forward as we move into some new technique or utilizing some new techniques. And we're actually going to have another CPE over the next few sessions about some AI and remote processes tools that we'll be using moving forward. SAS 143 relates to accounting estimates. This explains the nature of accounting estimates and the concept of uncertainty. If you have an audit report, there's likely a disclosure about the use of estimates in the financial statements. This guidance enhances our guidance on how we look and assess those estimates. It also requires a separate assessment of risk of those estimates. In our audits and deciding what our audit procedures are going to be, we're using risk as a barometer in order to determine the procedures that we're going to do. So this requires a separate assessment for estimates in particular. SAS 144 relates specifically to guidance for the use of specialists. So we're required to evaluate certain specialist credentials if, for whatever reason, maybe there's an amount for which a specialist has valued a line item on the financial statements. We're required to take a look at those credentials and evaluate those in accordance with our auditing standards. And then the last one is SAS 145, and that relates to understanding the entity and its environment and assessing the risks of material misstatements. So in our audits, we are required to understand the entity. We're required to understand, gain an understanding of an entity's internal controls and assess risk related to those internal controls. So this enhances that guidance accordingly. Moving on, there was one statement on standard for accounting and review services, SARS 25, that was issued during the year. The main change related to this was the use of materiality in a review engagement as a required practice. So previously, materiality was determined based on the needs of the financial statement users, but now it is a requirement to utilize. It also provides guidance relative to adverse conclusions in a set of financial statements, which we have. It is an audit opinion that can be issued, but it was not previously utilized in review reports for materially misstated financial statements. And finally, an update to government auditing standards, or Yellow Book. In 2018, there was a new version of the Yellow Book issued. It's effective on or after June 30th, 2020. There was a previous change in 2011 that introduced the uniform guidance, and it was broad sweeping changes. This is not that. The largest item that was tackled was a change in format to make the provisions easier to read by the users. It also expanded an independence requirement for auditors that says we cannot prepare financial statements under single audit. We can assist in preparing, but we cannot prepare them. And then the other item that I like to hit is it defines waste. So previously, the guidance defined abuse of funds received by entities, but this actually defines waste. And we are, as auditors, we're not required to perform procedures around waste. But if we do see situations that indicate such, we may be required to report on it. So with that, it'll take us into our next polling question. And this is probably the most important one that we have. So after the Steelers' weekend win over the Browns, how's everybody feeling about their chances for the rest of this season? You think they're going to the Super Bowl, playoff contender? Meh, it doesn't really move the needle, or just tear it down and fire everyone, like our favorite other people on the North Shore, the Pittsburgh Pirates. I'll give you everybody a few seconds to answer this question before we move on to Mark and his talk about changes to audit communications. All right, so it looks like pretty overwhelming results for meh. It doesn't really do a lot for anybody, which I think I'm on board with that. So it's good to see that we have somewhat of a consensus here. All right, Mark, we'll move on to you.
All right, thanks everybody for the continued feedback in the Q&A section. We're doing our best to resolve some of the echo issues that you're experiencing and the polling questions. Mary Lou will continue to respond to those as best we can during the program. I'm going to jump now to SAS 134, auditor reporting and amendments. SAS number 134 is going to result in a number of changes to the audit report. The next several slides will walk through those changes in anticipation of the audits that many of you will have completed over the course of the next, let's say, 6 months. We'll touch on the first 4 bullets on this slide as we walk through the next few slides, but I do want to touch on the last bullet here, optional inclusion of key audit matters. I think that's where some of the fanfare was, at least in the audit community when this SAS was originally introduced. So key audit matters are, the definition is those matters that in the auditor's professional judgment were of most significance in the audit of the financial statements of the current period. Key audit matters are selected from matters communicated to those charged with governance. So essentially, many of you are familiar with the letter that we issue in conjunction with our audit report. That's a letter to, quote unquote, those charged with governance. This key audit matters essentially pulls some of the items that are reported in that letter up into the audit report. So it could include items such as significant estimates, significant unusual transactions, areas with audit adjustments or control deficiencies. I expect that many of our clients will be satisfied with keeping the key audit matters in our letter to those charged with governance, but there may be some circumstances where governing bodies want to pull some of that information from the governance letter into the audit report, and I guess we're happy to do that and allowed to do that under our professional standards to the extent that we're engaged to do so. So now let's jump into some of the other provisions here. Well, first we'll talk about impact on the engagement letter briefly. Because the audit report will be changing, there will also be some updates to the engagement letter. You'll see new statements regarding reasonable assurance, regarding materiality, and regarding professional judgment and skepticism. Well, these aren't really new concepts. There will be new statements in our engagement letters this year regarding these topics. And then another change that you may see in the engagement letter is auditor identified significant risk of material misstatement. So we've historically discussed our preliminary assessment of significant risk of material misstatements with the audit committee. in conjunction with our planning. Now those are required to be documented either in a separate planning letter to governance or in the engagement letter. So depending on the circumstances, you will see those significant risk and material misstatements documented in one of those two places. We've included here and on the next two slides basically an example of the auditor's opinion. This is an unmodified opinion on a single year GAAP basis financial statement after the implementation of SAS 134. As you can see here, the report leads with the opinion. Prior to 134, the opinion came at the end. The first highlight demonstrates the statement regarding independence and ethical responsibilities. Simply says we are required to be independent of the company and to meet our ethical responsibilities in accordance with the relevant ethical requirements relating to our audit. And then the second highlight down at the bottom of this page deals with management's responsibility for going concern. So there will be a statement regarding management's responsibility and a statement regarding the auditor's responsibility. So it says here, in preparing the financial statements, management is required to evaluate whether there are conditions or events considered in the aggregate that raise substantial doubt about the company's ability to continue as a going concern within 1 year after the date the financial statements are available to be issued. So that's an add compared to previous reports. The next section of the audit report deals with auditor responsibilities. The first highlight here demonstrates the wording around reasonable assurance and essentially saying that it's a high level of assurance but does not provide absolute assurance. And then the second highlight here demonstrates the new statement about professional judgment and skepticism, essentially saying that in performing an audit in conjunction with generally accepted auditing standards, we exercise professional judgment and maintain professional skepticism throughout the audit. Obviously, that's something that we were doing previously, but now we will report that in our audit report as well. And then lastly, on the final page of the audit report, we have a comment regarding our responsibility for going concern. We'll conclude whether in our judgment there are conditions or events considered in the aggregate that raise substantial doubt about the entity's ability to continue as a going concern. And then finally, I mentioned our communication with governance, and we're now required to document in the audit report the existence of that communication, saying that we're required to communicate with those charged with governance regarding, among other matters, the plan, scope, and timing of the audit, the significant audit findings, and certain internal control related matters. That brings us to the lease standards. And as promised, we're going to wrap up today's A&A update with a section regarding the new lease literature. This literature was originally issued on February 25th, 2016. The objective was to increase transparency and comparability in financial reporting by requiring balance sheet recognition of leases and note disclosures of certain information. Since that original ASU, you can see that there have been, I think, 8 additional ASUs that impact Topic 842. Those subsequent ASUs generally address some comments and questions that arose as a result of the original 2016-2 or delayed the effective date. So at this point, the lease-related ASUs are applicable for privately held businesses for years beginning after December 15, 2021. The new lease literature is applicable to all organizations with leases. This slide lists some specific exclusions of what is not considered under the lease literature. And as Andy will talk about in a bit, there are a couple of transition options under the modified retrospective approach. We'll focus mostly on the impact on lessees today. That's where most of the change is. The impact for lessees, it's generally that you're going to put a right-of-use asset and a lease liability on the books for all leases with terms that are greater than 12 months. And Andy will walk through some examples in a bit that show that. Here we have a summary of the financial statement impact. Leases are now going to be classified as either financing leases or operating leases. Financing leases are similar to what we've historically referred to as capital leases. And really the accounting for those leases is very consistent with what it has historically been like. You put the asset on the books as well as a lease liability. You amortize the asset. You have interest expense similar to as if it were debt. And the cash flow statement presentation remains the same. Now, the big changes with the operating leases, and interestingly, I think when this standard first came out, folks thought it would look more like the IFRS literature where operating leases essentially got treated like finance leases, but that's not what transpired. Essentially, the operating leases do get put on the balance sheet as a right-of-use asset and a lease liability, but there's no change to the income statement reporting and no change to the cash flow reporting. So there's still just a single lease expense that's recorded on a straight line basis over the term of the lease. And Andy will show, how that works in some examples, but it ends up on the balance sheet, but there's no change to the income statement and cash flows. This slide here shows that there have historically been 4 criteria for evaluating a lease as an operating lease. And then now there are 5 criteria under the new literature. You'll notice that they have, the criteria are generally similar, but they've removed some of the bright line guidance. The 75% and the 90% thresholds have been removed in favor of a more principles-based approach. And you can see that the final new criteria down at the bottom right of this slide is that to the extent that the underlying asset is of such a specialized nature that is expected to have no alternative use to the lessor at the end of the lease term, then the lease should be classified as a finance lease, which is new in this literature. Okay, we made it to our final polling question. The polling question here has to do with the new lease literature. Question is, do you consider your organization prepared for implementation of the new lease guidance? Yes, we have an implementation plan and are ready to go. Not yet, but we're working on it. No, and I'd like to discuss with GYF, or not applicable to my organization. I know I've been, talking to more and more folks about leases over the course of the last couple weeks, and expect that'll be true through the end of the year. For many of our clients that have limited operating leases, the transition is not going to be too painful. And I think that most folks that have significant leasing activities have had, a lot of runway here. So hopefully folks feel prepared. But I guess we'll see as we jump over to the next slide here. So it looks like the vast majority of folks, either have an implementation plan and are ready to go or are working on it. Some folks not applicable because you don't have leasing activities, presumably, and then a few that like to discuss, and we'll be happy to connect with you folks after the program. All right, on to Andy for the examples and the wrap up of the program.
All right, thanks, Mark. So I'll jump right into my first example. So at first, we're going to talk about a new operating lease that's effective January 1st, 2022 with no initial direct costs. So in our example here, we have XYZ company enters into a lease of a building with ABC on January 1st, 2022. The building has a fair value of $100,000 and a 10-year useful life. The lease calls for annual payments of $10,000 over a 5-year term. and the lease does not transfer ownership or include a purchase option at the end of the lease. Finally, the interest rate implicit to XYZ is 3%. So based on that fact pattern above, this will be classified as an operating lease, and a right of use asset and lease liability, as Mark mentioned, will need to be recognized as of January 1st, 2022. Of note, if there is no interest rate implicit to your company, the incremental borrowing rate is used per the guidance. So on this next slide, I have an amortization table that shows the lease payments over time and the amortization of the right of use asset and the lease liability. So the first thing that you need to do is find the present value of the total lease payments over the term. So we find our present value here at the top, $45,000, $45,797. That's based on $50,000 in total lease payments at an implicit rate of 3%. So as you can see in the top right of my chart here, we have an asset and a liability that are both being recorded as of January 1st, 22 at $45,797. As we move to the left, you can see your lease payments that total $50,000 over the life of the lease. Moving to the right, next column, we have interest. And the reason I have interest in quotes is that this interest will not be recorded separately, but rather is shown here in the example to show the difference between the total lease payments and the present value that will ultimately be recorded as the asset and liability. The next column over are the lease payments less that quote unquote interest piece to show what the annual amortization of the asset and the liability will be. And then those far two columns to the right will show the annual amortization down to zero. And then on this next tab, I have in the first year our journal entries that are going to need to be recorded. So at January 1st, 2022, we'll need to debit a right of use asset for $45,797, credit an operating lease liability for $45,797. Pretty simple. And then assuming a single lease payment at the end of the year, we'll debit lease expense for $10,000. It's the same treatment as previous operating expense guidance, or operating lease guidance rather. We'll debit the operating lease liability by that discounted amortization amount, $8,626. And then we'll credit cash for $10,000 for the lease payment, and we'll credit the right of use asset for that same $8,626. So that's our first example. Moving into our second example, it's a new operating lease effective January 1st, 2022 with initial direct costs. So everything else is the same in our example here, except that in the last sentence, in order to obtain this lease, XYZ paid the previous tenant $10,000. So based on this fact pattern, it's still going to be classified as an operating lease. A right of use asset and a lease liability are still recognized. The only difference is that there are initial direct costs of $10,000 that are included in the determination of the right of use asset, and those are amortized over the life of the lease. Of note, there are some other items that can impact the initial recognition of a right of use asset. Any prepaid lease payments would increase that initial measurement, while any lease incentives received would decrease that right of use asset at initial measurement. This amortization table, I'm going to go through a little bit. We're running short on time. The only difference in this amortization table here is that your initial asset is $10,000 greater than the initial liability that's recorded. And I'll show you how that happens. And then there's also an inclusion of quote unquote amortization of initial direct costs here. But on the next slide, I'll show you how that is recorded on the income statement. So at January 1st, 2022, there's an initial right of use asset of $55,797. Initial liability of $45,797, and then cash or an accrued liability related to those initial direct costs of $10,000. And then for your annual lease payment, you would debit lease expense in this example for $12,000, which is the lease payment of $10,000 plus the first year of initial direct costs of $2,000. And then the operating lease liability and cash are the same as the first example, and the right of use asset is increased by that $2,000 for the initial direct costs. I'm going to move a little quickly through these last couple slides here. There are two modified retrospective applications for this in transition. The first is a comparative option, where the standard is applied at the beginning of the earliest period presented in comparative financial statements, with a cumulative effect adjustment to the opening balance of equity in that period. So if you're presenting December 31st, 2022 and 2021 comparative statements, this would apply as of January 1st, 2021. In this case, disclosures that are ultimately required will be more streamlined. The other approach is the effective date option. This standard will be applied at the effective date with a cumulative effect adjustment to the opening balance of equity in the period of adoption. So if you're presenting those same statements, 2022 and 2021, this would be applied as of January 1st, 2022. The disclosures will not be as streamlined. There's going to need to be some additional clarity there for the differences in periods presented. There are practical expedients available. I'm not going to go into them in detail, but basically at a high level, they say that if leases have been appropriately classified under the old guidance, you need not reassess certain pieces or the classification of those leases. So you must utilize these practical expedients on all leases and apply them consistently to all leases. But yeah, I would recommend looking at the specifics in this literature so as to not, or so to be able to utilize these practical expedients. And then the other is the hindsight practical expedient, which allows you to use hindsight to determine the term of a lease, which may increase some complexity in reporting. It could create a different term for your lease than you initially had, which could lead to greater lease payments, difference in lease payments. So this is, if you're using this, you also have to apply it consistently to all leases. And then just a few quick things. The impact on lessors, it's substantially similar to our current model. There's some conformity for the new revenue recognition standards here. There's a policy election for short-term leases, where leases with terms of 12 months or less can be recorded pretty consistently with previous GAAP. However, there are a couple provisions here that they should be evaluated for capitalization potentially. And then there's some other matters here. Term is important. It's defined as the initial term plus likely renewals. Once that's established, there are only a few conditions for which that can be reassessed, and I've listed those here. And then here's a couple other matters, something like, if you have a bundled lease with a number of leases in one, those need to be segregated and consideration given to each component. There's also some clarified guidance for sales leaseback, and related party leases. And then there's going to be, with anything broad sweeping update here, there's going to be updated disclosures, probably increased level of disclosures than what you've had previously. It's important to consult with the guidance when looking at these new disclosures. So with that, we've come to the end of our session here. We're happy, Mark and I are happy to take any questions. Our information is here to do so. If you have any administrative concerns, they should be directed to Mary Lou. Her email is there as well. We just wanted to thank you for your attention today. We really appreciate being able to present this information to you, and we hope you found it valuable. So thank you very much.